Real stories, expert insights, smarter decisions.
What do you make of the market at the moment and in the federal budget?
Game has changed. The real challenge with the economy now for younger Australians trying to get ahead is, how do I build an income out of property now faster?
What makes a bad asset at the moment? What would you be running away from?
You see a lot of spruikers in the market capitalize the hell out of this new build scheme. Remember, the economics of the negative gearing will mean that rents will go up as well, because it will stagnate prices and rents should go up relative to the price. So yields are going to get better. The property people won't like that because it's all about growth and that's how they make money. But I'm almost like all about the fundamentals, and the fundamentals haven't looked fantastic for a while.
And it makes me question, are we going back to what property investing was 15, 20, 30 years ago?
Negative gearing, yes, it's helpful in some circumstances, but it does justify investing in a poor asset. Like, I spoke with our lending department. You're going to lose 20 to 30% on your lending capacity once this is all washed out.
As a result of no more negative gearing.
Either way, up to 30% difference. So what's that mean?
Tune in and find out.
Well, g'day everyone, it's Liam Garman here, co-host of the Inside Residential Property Podcast. And today, our first episode on the other side of the federal budget. Now, we're going to be unpacking that in just a second, but it's a very changing world in the world of residential property investing, of course, all the tax implications and tax changes, but also changing interest rates. But not everything's doom and gloom, and we're going to be talking about it today with changing interstate migration patterns and what is probably going to be a year of rapidly decreasing supply. The fundamentals in residential property investing remain unchanged. And talking me through this, our expert, Scott O'Neill.
Good to be back. Good timing. We'll talk about all this budget stuff, but everything that's happened has actually pushed. The strategy is exactly what Rethink follows. Our strategies were built for a non-capital gains tax, a stamped, or basically the negative gearing ratio being applied. We're built for not benefiting from that. We like higher yielding assets. We like stuff that you can actually hold and not rely on just selling or flipping. So if anything, it will push more people towards our strategy. And the game has changed basically. So we'll go through all that and the implications, because it's very important as an investor, you're aware of the changes and what asset classes and specific types of properties will do better or worse in the new environment, because it will separate the good investors to the ones who are just following the old rules.
I couldn't agree more, especially on the negative gearing front. That strategy very much aligns with my perception of negative gearing, which is it shouldn't be a crutch. You shouldn't rely on it. No. Fantastic if you can access it. But at the end of the day, if your financial freedom or if your financial flexibility ends up relying on at the end of the day, relative to the cost of an asset, a pretty small tax discount or a tax break, you're not doing investing right. And if removing that makes or breaks your portfolio, you're actually in quite a questionable financial situation. What do you make of the market at the moment and in the federal budget?
Look, I'm probably a little bit different from most property people out there, because I really thought negative gearing, yes, it's helpful in some circumstances, but it does justify investing in a poor asset. It just justifies taking a lower cash flow than you should. And the result of that in economics is you end up paying more. So there is a reason. I see why they've removed it. The funny thing is they've created this two-stage, they're basically locking in intergenerational inequality, should I say. So why would all the others who've been doing it for the last 30 years get the rule, and then the next young Australians don't get the rule? It's a two-speed economy. So it's a little bit unfair in that department. You would think you would somehow even the playing field a little bit more, because it is going to be a significant benefit for those who are still in the market. It'll justify not selling a lot more. It's going to push rents up. There's really little doubt that rents will go up. Even from a mindset, you've got to think it's not even just about supply. You've got all these landlords in Australia who have got 3 interest rate rises already on the cards. That's been already played out. Then you've got worse cash flow coming in from a tax point of view. So what is the mindset of an owner? They're going to think, well, I've got to get some of this back. Normally, I know a lot of investors might have a really good tenant that's been there 5 years, and you're going to be nice to them. You're going to say, look, I'll just raise you $20 a week because you're a good tenant, you're safe. you're like that comfortability and just being a little bit more easygoing is going to evaporate. People have to get their margins back. So the mindset is you're going to push for the max rent you can, even if you're the most nice guy or girl out there. Like you kind of have to do it to make the numbers stack. So when every landlord in Australia is thinking that, it's going to be upward pressure on rents, and then add to that more tenants looking versus the supply. It's going to be it should be a really interesting year, and probably not the best one for tenants.
Capital gains tax, what do you make of the changes there? Anything that investors need to be aware of?
Look, you're simply going to want to buy and hold forever more now. Like when you've got to sell off. So again, the game has changed. People must respect that. Buying a house and then flipping it in 10 years' time, there's just so much tax you've got to pay. And then you still got to redeploy that capital and pay stamp duty again. And, whatever you got to do in terms of selling the asset, you've got agent fees and that. It's almost just not worth selling unless you hold for a very long time. And that does create a slower path to wealth as well. So the real challenge with the economy now for younger Australians trying to get ahead is, how do I build an income out of property now faster? Because the old model of buying 3 or 4 or 5 houses, letting them double and then selling them down to pay half the debt off and maybe getting a commercial, it's a lot harder than that now. Basically, everything's stretched out. So you've got to go towards more high-yielding assets quicker because you just can't rely on the growth as much. You've got to rely more on the income, which is really how most, I guess, property markets in the world operate. We're in a bubble, so some other countries like Tokyo, Korea, they've got very low yields, a lot of these countries, but a lot of the others are the opposite. They're all for cash flow. You look at places like Italy, they haven't had much growth for the last 20 years in some areas, so it's all cash flow. So I'm not saying Australia's going to go the way of Italy, but there's going to be it's going to be a different environment. The growth we're seeing in the last 40 years in Australian residential property will not match the next 40 years. It's almost impossible. And there's one other big reason is, think about how there used to be one-income households 40 years ago. Now there's 2-income households, and all that's just gone straight onto mortgages. So people have doubled their loans. That's double house prices. That's not going to happen again. There's no trump card there. You can't have a 3rd or 4th income in the house. Or maybe you can if kids start working and paying but either way, that's going to be a minority case. So main message is less growth for residential. So what are you going to do about it?
It's a pretty controversial thing to say that model, which I think so many people in the real estate market relied on for years, which is substantial growth, sell down, consolidate, and move into commercial property or really high yielding resi. But I really appreciate your point, because we are used to this in the last decade, I guess is a very fair timeline, a decade of, if you are buying strategically, you're getting these 15, 20% per annum returns. So waiting for the asset to double actually wasn't out of the question. It was doubling way before that 7-year historical average. And it makes me question, are we going back to what property investing was 15, 20, 30 years ago, which is you expect that 7% per annum return, and you have to acknowledge it is a longer game. You have to acknowledge that if you are out of pocket, you're going to be out of pocket for years and years and years and years and years. You can't just consolidate down. Where you do have to invest strategically, you have to have higher caps on what you're willing to spend. You can't just expect that the market would do all the heavy lifting for you, which we have for the past 5, 6 years plus 10 years. Scott, what does investing strategically look like for you at the moment? What should investors be looking out for, and what's the mentality that they should be bringing to investing?
Yeah, look, it's a good question. So I sat down with our residential team this week, and we're basically not changing the strategies, but just tweaking them. So I guess high level, we're looking at more affordable properties that have higher yields. So whereas a lot of people were buying 900 grand properties with us, we're getting like I spoke with our lending department. You're going to lose 20 to 30% on your lending capacity once this is all washed out. So that's going to have impact on your ability to buy a certain value properties.
That's as a result of no more negative gearing.
Yeah, and then you've got the interest rates mixed in there. So either way, up to 30% difference. So what's that mean? Prices, like how you're going to push the prices up when you've got that kind of, I guess, current downwards on the lending side. So it's a significant thing that needs to wash through. I think you're going to, you see a lot of spruikers in the market capitalize the hell out of this new build scheme. They're all going to be feeling great about the fact that, you know, their massive house and land packages out 3 hours west of Sydney is going to be a really good investment because they're building 2,000 of them. Like, be careful of that. There's definitely house and land packages that will work. Like, I particularly like ones that are like at the lowest price point where the yields are a bit better. Infill jobs, big priority. You know, and an infill job, for those who don't know, is basically like a landlocked suburb. It's not an urban fringe where you can build out towards Alice Springs. You're literally in a suburb that's got, you know, established houses around it. There'll be a lot of those pop up. They're good deals. You'll get your full depreciation benefits. You'll get your full negative gearing benefits. Not a bad strategy. And at Rethink, we've done a lot of those. We were doing dual keys back in the day in places like Brisbane, Adelaide, and they all doubled in 7-8 years as well. So they were really good when you were getting 6, 7, 8% yields too on those things. So you're not going to get those yields these days, but remember the economics of the negative gearing will mean that rents will go up as well, because it will stagnate prices and rents should go up relative to the price. So yields are going to get better. So it will get better for an investor, and that's probably better for the overall economy anyway. The property people won't like that because it's all about growth and that's how they make money. But I'm almost like all about the fundamentals, and the fundamentals haven't looked fantastic for a while.
What makes a bad asset at the moment? What would you be running away from?
All like the spruikers. Like, you're going to have a lot of people say buy into this area in the middle of nowhere for $1 million for, you know, a crappy 3 or 4 bedroom house, and there's no proven tenant market out there. So be careful of markets that don't have proven tenant demand, because the new build market will pump. Like, that's the whole, Australia needs it, to be honest. High-rise apartments run like hell from those, because the only way to fix housing supply in Australia is if you rezone all the middle ring suburbs in every capital city and build Harry Triggerboff style Meriden apartments up. That's the only way to do it. Whether or not councils will allow to do it, that's a different thing. You can't urban sprawl fast enough or efficiently enough. Like, I've spoken to demographers, to economists, and the cost of putting roads and infrastructure and all that out there, it just doesn't stack up versus what people can afford. And then you add build costs there. Unless technology changes with building, and it will at one point, there will be the ability to 3D print a house on scale that's at the same quality as what we're seeing. But until that day, we're relying on trades. We're relying on all the usual building materials and the long, you know, year plus build periods that you can experience. That all costs money. So they're not going to fix the housing supply that way, but building upwards for sure. So I wouldn't invest in an area where you will see the most potential supply.
I couldn't agree more. You know, everything comes down to the supply-demand equilibrium, right? And, you know, I've got a lot of areas that I'm very interested in buying in, Scott, and I set up notifications for areas when there's your value, and just publicly on market properties. There are markets that I look at where I genuinely think listings are falling quite substantially, and these are areas, I'll just be honest, around like the lower North Shore of Sydney, because despite the interest rates, despite the changing negative gearing, there is a market there that is resilient and able to afford it. And you can almost see it in real time, that hurting to the never sell investor, because I am just not seeing new listings. Other areas where I think you did have over leveraged investors, not going to necessarily name suburbs, but you are seeing what I think would be, and I'm talking about within 10 kilometres of the Sydney CBD. Yeah. I think there are areas with quite a substantial fire sale going on, and I'm seeing prices drop in real time. Like agents are dropping in real time. So the supply demand equilibrium there is, it's unique. To your point about the new builds as well, I think it's very fair to say, you know, 53% of new builds, and it's a stat I talk about all the time, but in terms of large apartment blocks, and you're saying, you know, avoid them, run for the hills, 53% of large apartment blocks since 2019 have got major defects in Australia, in Sydney. It's mind-blowing. Then you add in, so the cost of defects, but then you add in debt costs of building entire new suburbs. It's going to drive up prices, cost of material, award rates going up. The cost of the new supply is also going to go up quite substantially as well. And when you factor that in to the bare basics of you got an asset and you got a replacement value. And when the replacement value is so much more than the asset, eventually the established dwelling is going to have to come to the party as well.
Yeah, for sure. And look, I think it's important to raise the difference between those old school unit blocks, you know, your 3, 5, 6 level
Survived
type
nuclear
stuff.
war, some of them.
Yeah, and that's
real
the
solid
thing.
bones.
Double brick, like, you know, you can go into a merited apartment and punch your way into the next apartment. Like these old buildings, they're built properly, and they had less restrictions on costs back then. The quality control, like they over-engineered the buildings essentially, and that is extremely important when you're thinking, all right, I'm going to buy a property, hold it for the next 40 years, because some of these buildings they're building in, like, you know, Opal Tower type esque type stuff. They're not going to be around in 40 years. You know, they're just not built to the specs. They should to last that long. So there'll be huge strata costs, sinking fund, like levies raised. That's going to eat into the yields. And remember, it's very important to work out the net yield as well. Like residential is unfortunately a world where everyone just forgets half the equation and just says the gross yield is 6%. But what about if the strata's $5,000? You know, like it's not a 6% yield. Like you got to work it back. And so that really does kind of change the game as well with the cash flow. You got to be important. And the smaller blocks have lower strata. They always will. There's like some don't have lifts, some don't have swimming pools, gyms. Like you can go to the next level and they've got full-on security guards and like indoor swimming pools that need to be refurbed every 10 years. Like that's
You've
massive.
got literally full-time employees that work there.
And you'll be paying for that.
Yeah, you are paying for that. Now, we do have an investor that is joining us online. Now, we've got Nick Taylor. Mate, welcome to the podcast. To kick us off, Nick, give us a little bit of background into yourself, into what you do, and your property investing journey.
Thanks for having me on, Liam. Look, I moved to Australia from South Africa 20 years ago now. So came with not a whole lot to show for myself in terms of financial capital to work with. Came as a 20-year-old. I'm now married with 2 kids and have been on a fairly typical property investing journey, I would suspect, using first homeowners grant to get into my first home, and then turning that into an investment property and trying to build a little bit of a portfolio, and probably facing a lot of the same barriers a lot of people do around kind of maxing out serviceability with lenders, and a few challenges like that along the way, which I'm sure we'll get into when you ask me some questions about what I've done. But on the personal front, look, I'm father to 2 boys, live in Wollongong, just south of Sydney. I'm also a paraplegic as a result of a motor vehicle accident when I was a youngster. And that's probably shaped my thinking a fair bit in terms of investing and trying to build some sort of financial sustainability for the future, knowing that I'm probably less secure in my employment than a lot of people would be. I have a professional career in management consulting and banking. I also played a lot of sport along the way, and currently working in philanthropy for one of the largest philanthropic trusts in Australia.
Oh, that's fantastic. And, you touched on a very important point there, which I think is in the back of a lot of people's minds, which is the need to have that financial freedom and to have that backup in the event that something were to happen in the professional or personal life, and having property there as a bulwark for whatever might happen, but also for your family and to support them. Starting off with a bit of a portfolio breakdown from yourself, your first property was down in the Gong, am I correct?
Yep, that is correct. Look, this is probably one of my first mistakes, to be honest, and lots of learning through the journey of my property investing. But I bought my first home before I got married, and wanted to take advantage of I think it was $7,000 first homeowners grant back in 2010. And for that reason, put the property in my own name only, as opposed to joint names with my wife. And that came back to bite me in the ass down the track when I sold the property and was on the maximum tax bracket and ended up paying a lot of capital gains tax as a result. But that was, taking a first home and then trying to turn that into an investment property when my wife and I bought our own home together. Probably just not being particularly intentional about the structure and the way I went about investing. But that was the first property, the first home in Wollongong, in a flood zone, backing onto a creek. sloping block, not particularly useful in terms of adding capital value or generating any sort of equity from the property. But on the positive side, it was a step in the right direction in terms of having an investment, even if it wasn't great.
The property number 2, you went down the apartment route in Coogee.
Yes. So I used a well-known buyer's agent in the eastern suburbs to help me buy a 2-bedroom, 1-bathroom apartment on the edge of Coogee and Randwick, sort of walking distance to Coogee Beach. And yeah, I guess you assume because you're using a buyer's agent that you're going to get a good deal, and it's going to be a good investment, but it's been a bit of a dog in terms of return. Bought it back in 2016, so I held it 10 years now and still negatively geared, and is probably gone from $1,075,000 back in 2016 to being worth about 1.45 now. So if you work out the return over 10 years, that's not very good at all.
What
but
would
again,
your holding costs over the last decade be on that? Like you mentioned, it's still negative geared. What would be the average negative cash flow per annum, you think?
look, I'm probably somewhere in the between 100 and 150 bucks a week still in terms of subsidizing
wow.
that asset. So yeah, it's not, it hasn't been great in terms of investment fundamentals. Again, it's better than doing nothing. So I acknowledge that, but it just wasn't a great investment. And if anyone asks me for advice now, I'd be saying, don't go near apartments, house and land somewhere the dirt is what appreciates. Like, I won't be doing that again, but that's a lesson learned along the way, I guess.
Those stats are quite interesting that a lot of people would have picked up on, because obviously over the last 10 years there have been such substantial rent increases in Sydney. Nick, what do you attribute that to, the fact that it's still negatively geared?
Look, I don't think it was a great buy or great value at the time when I purchased it. I remember looking at the alternative, which was actually a house in a northern suburb of Brisbane called Grange. And in that suburb, I was the underbidder at an auction at $705,000. Property sold for $706,000. And no one had a crystal ball, obviously, and hindsight's marvelous, but that suburb went ballistic. And that same property, I keep track of it because it was the alternative to the property that I bought in the eastern suburbs of Sydney, and it's sold since for over $2 million. So I look at the opportunity cost of the unit that I ended up buying in Coogee and the property in Queensland and think, wow, there's a big difference between the equity gains on those two scenarios. And yeah, that's why I think.
Now, Nick, you moved on to property 3 down in God's Country in the Sutherland Shire in Sydney.
Yeah, this was a house in Caringbah South that I bought in 2020. So when everybody was panicking about the impacts of COVID and saying property prices were about to tank and kind of running for the hills in terms of property investments, we made the brave decision to buy a 4-bedroom, 3-bathroom, double garage home in Caringbah South. And that's been the best property investment that I've made. Fair bit of luck involved there, but I guess when you are a little contrarian in terms of buying when other people are selling, or buying when other people are anxious to buy, I think that generally works out well in property, just as it does in the share market.
Yeah, and the Shire's had an incredible run too, especially places like Caringbah South, quite close to Cronulla, more of a premium suburb. There's been rapid growth down there. Like I see there's record price after record price still down there in some of those more expensive Cronulla suburbs. But it's really just pumped by the owner-occupier market. There's such a strong culture down there to buy a family home, and that contributes to basically putting it all into a family home. And that's a great thing for exactly what you bought. That trend won't go away down there. So well done on that purchase. Yeah, especially in the middle of COVID too. I remember that time. That was a bit make or break for maybe only 2-3 months, but then it felt pretty good.
Yeah, it was a bit scary at the time though, because there was certainly a lot of naysayers about property values, and turned out to be fortuitous.
Now, Scott, what do you make of the portfolio in its whole, and what would some of the next steps for Nick look like?
Well, look, at high level, you can see cash flows, the weakness, which is the standard kind of portfolio we see when they come to Rethink. Because you're chasing capital growth. Like, it worked at the time. Like, I get the strategy. You probably wouldn't change too much of like the growth mindset back then. Like, if you knew what you knew, like, you know, COVID, you would have just loaded up on the biggest possible debt you could ever afford back then, and you'd do well. This is not a portfolio you'd repeat in the current market. That's the big difference. Again, I remember the game has changed. So you've got to be careful with those sort of lower yielding ones. Like the Coogee apartment surprises me how poor that's performed. So, like, as you said, maybe it wasn't purchased well. Because Coogee in general is one of those undersupplied markets. There's a strong tenant pool. The problem with a place like Coogee, because I'm still a fan of like the red brick type investment if you can get it right, but it's really got to be at the bottom end of the market. I'm talking way under $1 million. Like, you know, you can buy these things in Melbourne for under $500,000. The yields are 5-6%.
Yep.
There's many equivalents of that around
And
the
the
country.
replacement costs $800-900.
Exactly.
Right? Yeah.
But the Coogis of the world, like you're talking double, triple, and the yields don't sort of catch up a lot of the time. But I guess one message is like the market has been very favourable to, you know, the likes of Brisbane, those house and land type places. It always will because it's undersupplied. But you might see you might see Coogee actually have a decent decade ahead because it's due for growth. Remember, like your one in Brisbane that's now 2 million. It's probably not going to go to 3 mil real quick. So the percentage chances of growth are much higher in 1.4 mil for Coogee, I think, at the moment. So you'd almost be careful selling that one. But yeah, look, $150 a week negative. That's something you've got to be wary of too, because you don't want your portfolio to become this giant burden, because you're not going to retire from it as well. And this is what everyone kind of forgets as well when they're building a portfolio. They're working to support their portfolio, and they don't calculate when that portfolio will actually switch and look after them. Because you need, you know, what is it, 100 grand, 200? Everyone's got a different number, passive income they've got to achieve, and you've got to almost fix the problems too. It's not just about acquiring positively geared properties; it's about fixing the negatively geared ones somehow. Whether it's rental raises, paying debt off, just selling it, getting rid of it, because then you're not negative geared 150, but then you've got to calculate the opportunity cost, which Nick, you're obviously an expert at, looking at the opportunity cost. But yeah, it's a good play. Like, I guess the other comment, you got 3 in New South Wales. You'd probably want to get out of New South Wales. The land tax rules here are pretty brutal. But yeah, it all depends on how much equity you got in the portfolio, which will determine your next steps.
Yeah, look, I do have a fair bit of equity already, but I am paying a significant amount of land tax at the moment, and definitely not keen to add to the land tax burden. Thinking about when the right timing would be to exit that apartment in the eastern suburbs. I know apartment prices have got to catch up to, I guess, house prices at some stage, or catch up in some way. So I don't want to miss riding that wave in terms of getting the equity uplift that we're all chasing as growth investors. So want to be intentional about when I exit that, but probably looking to exit that one at some stage and relieve a bit of the land tax burden and look to invest into state.
Yeah. My advice with that is really just, so talk to your accountant, work out exactly what you're after. Tax deposit amount would be after selling. Like, you obviously got to assume a sale price and pay sales agent fees and all that. So you'll be left with a certain amount, and then have a look around what you could get in that price point, because the mistake a lot of people make is, I'm going to just delay selling because there's more capital growth. But there's going to be more capital growth in the other asset you're going to buy anyway. So it's better mathematically to buy and sell in a low market because there's less tax, less sale agent fee, than buying and selling in a high market. Like, I'd rather sell it at 1.4 than 1.8, assuming the other property you buy is at the same price.
Because you're both buying and selling at a lower
Yeah,
watermark.
just get it done while it's cheap in a bad market.
Yes.
And then you're shopping in a bad market too. So the negative cash flow will be one of the determining factors there. Like, so you can immediately fix that. So you've just improved your situation by $150 a week. If you had enough for either couple of more. You mentioned you're sort of against the apartment route, so you'd almost be looking at commercial next to turn that into a $400-500 a week positive situation. Like that's the flip. So overall, you could turn a negative 150 a week into a plus 500 a week. So that's a 650 turnaround just by trading in and out. Like that's a good day.
Hey, Nick, when did you last get the Coogee place reevaluated?
I've got a local agent managing it for me, and they've given me an idea of what they think it's worth in the current market. And I know I'm under rented at the moment, and I'm waiting for the anniversary of the lease to be able to bump the rent up to closer to market rates at the moment, which will help with that negative cash flow situation as well. But in the last 12 months, I've had the conversation with the agent about the value of the property.
One thing to be wary too, there's probably going to be a lot more owner-occupiers potentially in that space versus investors, because it is not a good investment with the new rules. Like in terms of, well, should I say it's a worse investment with the new rules because you can't negatively gear it for new investors. So their budgets are going to be reduced by that 20 or 30% odd with the interest rates included as well. So maybe the owner-occs, because they're thinking no capital gains tax on an owner-occ, that's the route they're now going to go on. And I've spoken to many of my staff. They're actually looking at that strategy versus buying an investment. But you got to really remember, is that the family home you want for good? Because you're going to have to trade in and out of that. And the mortgage is generally...
What strategy are they thinking about? Buying the PPOR and just like hammering it down?
Yeah, because it's, again, everyone's just trying to avoid the tax. So, and it makes people make sort of poor decisions. Buying a family home can be a great option if that's the one you want and you're going to set there. But even when I first started Rethink investing 11 years ago, it was everyone would buy a 1 or 2 bedroom unit, sell that, then move into a 3-bedroom townhouse, sell that, then move into a 4-bedroom house. Like there's 3 trades, there's 3 stamp duties, there's 3 sales agent comms. Like it's not just the tax, it's significant amount of purchasing costs you're acquiring each time, plus moving, all the hassles. Like sometimes it's just better to rent for those 10 years and go straight into the 4-bedroom house. If you need that.
100%. I couldn't agree with you more. I think that's one of the challenges with the old advice, that people would get from, Uncle Dan at the barbecue or their parents. And this isn't to say, it's impossible now, but it's to say that the strategy's changed, because you're 100% right. If you started with the apartment and then you traded up to a house 50, 60 minutes from the CBD, and then you slowly build to your forever home, which was the notion that everyone always worked towards, right? That was at an era where your stamp was a sixth of what it is now. I was looking at just the stamp duty calculators online, and 60, 70, 80 plus thousand for a 3-bedroom apartment in Sydney, it adds up quite quickly, and that is not something that you can do to constantly trade up. Scott, Nick mentioned that unit was bought with the support of a buyer's agent, and not to spend too much time focusing on the unit, but I think a lot of people, that would raise a red flag for them. What are some red flags that people need to look out for in BAs to avoid that kind of situation?
Look, the big one is, has the buyer's agent made their money from their buyer's agent or an investor? Because it's a lucrative market. If you're a big buyer's agency, you can make a lot of money, and then you just pump it into a whole bunch of, average houses around Australia, and that's the theme in this market. So you don't want to follow someone who's got an advantage that you don't. Like, because you're going to make money the real way. You've got to make it through investing, not just through redeploying profit. So rule number 1, just follow those who've invested and done well prior to having a buyer's agency. Otherwise, they're just buying the same supply you're trying to buy, and you're competing with them in a way. Number 2, just make sure they're an investor-focused buyer's agent. Like otherwise, you'll get into those area ones where they're just going to say, "We want you to buy in the eastern suburbs because that's where our connections are." And then you might run into this situation where cash flow is totally thrown out the window. They're not looking at anything other than how much is your budget and what can we get you as quick as possible for that budget. They're not scouring around going, oh, maybe Hobart has got a bit more upside in it. Maybe, it's time to get back into a certain suburb in Brisbane. Like, you got to look at the whole market, just like a stock investor would. You're not just going to invest in, a share because it's local to you.
Mm-hmm.
So yeah, you got to be kind of borderless, I guess. And other red flags, anyone that's just pumping off the plan stuff. It's going to be a spruiker's haven for the next 12 months. So there's going to be all sorts of large scale, I guess, house and land packages that have that 40, 50 grand fee inbuilt into it, commission.
Yeah.
But you can still buy a good house and land package, but remember the rules. It's got to stack up fundamentally. Proven rental market, infield, at least comparably cheaper than other new builds. Like, it's got to have something going for it.
And for people listening that, might not be too aware of that, now they're not buyer's agents legally because they don't have their real estate licenses, but you have a lot of, buyer services type support out there where they charge either no fee or a very limited fee to help buyers, but they get that $40,000-$50,000 from seller in terms of the house and land. So it's not uncommon that you would find with these big new sites, with these big developments, that once people start selling on the other side, they're selling at a 50, 60 grand discount from what they originally purchased it at, plus all the holding costs and the transaction costs. Nick did make a pretty awesome decision with the Shire property, Scott. And I'm looking at it, and it seems to be almost quite similar fundamentals to what we're seeing now, in so much as he bought when confidence was low. He had the guts to go in, take an opportunity when it arose. Seems to be a bit of a similar confidence, consumer sentiment piece that it is now.
Yeah. Well, look, we'd love a 4-bedroom house in a good market. Again, Caringbah South, there's no real free land down there anymore, so it's forever undersupplied. It's a desirable suburb, so you're always going to get the pick of the capital growth in those areas. So the only problem with that investment is just, again, it would be the cash flow. But are you living in that place, Nick?
No.
So
I've got actually family living it at the moment, so I'm able to manage it myself without needing a managing agent. And
what's your rough gross yield on that one, out of interest?
It'd be in the mid to high 3%, 3.5%, which is a lot better than the apartment. Surprisingly, I would expect apartments to have good yields. When you were talking before, Scott, I was just thinking about what makes a good purchase in the residential space at the moment, and I still think you need to be looking at yields. People don't talk about yields in residential enough. You do that in the commercial space, but it's equally as important in the residential space.
100%. It's like running a business. If you forget net income on a business, then what are you doing in business? Your portfolio is a business. Like, it is there to look after you. And somewhere along the way, everyone just forgot that and just went, it's all about the number of properties or how much growth I'm getting. That's actually not even important. It's like, how much income are you getting? Because you are going to keep working until you've got income. So if you're happy doing that, that's fine. You're just basically buying to accumulate assets, and that's fine. But if you're looking to retire or at least create flexibility in your life, yield is everything. Yield helps with lending. Yield helps with even a determinant of value. So, like, the market is going to skew towards high yielding assets. So there's going to be a lot more people like us want higher yielding. What does that mean? More demand for high yields. What does that mean? More growth. So you're going to see higher growth for the better yielding assets, and these super low yielding apartments or even higher priced ones, they're probably going to have a rough few years ahead because people simply can't afford to hold them.
Yeah, no, couldn't agree more. Hey, Nick, what was your biggest lesson looking at Caringbah, looking at Randwick, and everything throughout your journey? What is the biggest lesson, and what would you have done differently if you had restart your journey now?
I think being really intentional about what it is that you're trying to create. So starting with the goal and working backwards from that would probably be how I would advise somebody else to learn from my mistakes and do things differently. I think the biggest challenges are the structures in which you purchase and getting the things set up to be able to not pay the massive capital gains tax because I kept the property in my own name instead of kind of investing jointly, for example, when my wife earns significantly less than I do, and would have been great to be able to share the capital gain. So I think it's just having a good strategy. Like getting really good advice, actually harder than you think. To get somebody who will actually work through your personal circumstances and help give you great advice to set up a really intentional strategy around what you're trying to do and where you're trying to get to. I sort of fumbled my way through that and learned a lot along the way, but those are expensive lessons, and be really good to have an intentional strategy up front and invest in the right structures.
Yeah, and I'm going to chuck in something. So the solution to that we've created it's a plug for Rethink Wealth, and this is not a buyer's agency. And it's such a good point you raised, Nick. You will not get that strategy from any buyer's agent, including us in the country. It's because we've all got our own different views on how the investment world works. Like I'm obviously pro yield, pro mixed portfolios in terms of resi and commercial. Then you've got people that just buy the cheapest possible thing they can find in Australia. Then you've got the blue chip investors. They're all going to just sell exactly what their strategy is. But if you go to an independent financial planner, so we've got Pat Casey, he does all the plans for our staff, and an example of how accurate they are. He has to redo all the plans now because of this budget. All the advice they got prior to that is now different because they map out a 20-year plan and shows your cash flow year by year, like how negative it is and when does it switch over to equilibrium and then when you should sell. Like it's a real complex plan, which I personally never even had because I was just into the just buy when I could strategy. But they'll tell you when you need to sell and when you need to kind of change the ratio of resi versus commercial, or maybe commercial's never for you, depending on your situation, because you're in a good, safe, you got a business that's going to give you passive income after retirement. But they factor in all those, and that's probably the one. I guess warning: don't get it from an advisors agent, including us. Like we'll point you to the direction where the market's growing, and that's where a financial planner can't, because they're there to work with your exact situation. But outside that, you then get the plan and you buy to that plan. And if they say buy owner occupier, it's probably the right decision because they're factored in legally through an AFSL, Australian Financial Service License, your entire strategy. It might be shares. But yeah, that's really what we're seeing solve that problem with the plans because no one's got one.
Nick, final question for yourself. You mentioned before that turning your first home into an investment property wasn't the best move that you could have made. I think a lot of our listeners would be quite familiar with Wollongong. It seems to me to be a place which holding a home in isn't necessarily the worst thing ever. Can you explain to us why you thought holding it as an investment wasn't necessarily the best move?
Yeah, I think, again, it comes down to opportunity cost. The investment fundamentals of that first home weren't great. I bought it in a rush to take advantage of a first homeowner's grant for what was $7,000 at the time. In hindsight, 15 years later, that is such a small proportion of the capital gain or the kind of financial considerations for that property. Yet it guided the fact that I bought that home in my name and not in joint names. And I made a bunch of decisions based on a small $7,000 first homeowner's grant, and then ended up keeping that property for what ended up being 12 years. And yeah, I think I just wasn't very intentional about the underpinning fundamentals of that as an investment. So I think if I did it all again, I would probably build a strategy around why I was investing and what I was trying to achieve, and go and be intentional about buying something that met those objectives rather than just kind of doing something because I had a property and decided I was going to turn it into an investment property.
No, I think that's very reasonable. Nick, thank you so much for your time. Scott and I are going to have a little bit of a chat offline about what Scott makes of the portfolio and what he might do differently. Thanks so much for your time, Nick.
Appreciate you having me on.
Looking at that, I think it's pretty fair to say, Scott, the overall theme that keeps popping up, and it's popped up a few times, is don't hold for the sake of holding. I think that's a very reasonable point, which is investment property number one, purchased for $460 at the end of 2010, sold 13 years later for 1.1, doesn't look too bad, but holding costs over a decade, nearly a decade and a half, adds up, as is the property in Coogee. There's going to be a lot of people out there that think, hey, I've already got it. I've already got a PPOR. I'm just going to hold, buy another one, hold and buy another one. It clearly doesn't necessarily work with an overall strategy.
Yeah, look, I think, as I said, buying and sell in a low market is the time to do it. Sometimes it's hard to sell when the market's down because there's economic stress or there's something going on with banks where they're not lending as easy. So it is easier said than done. But if you have a bad asset, now's probably a good time to trade out of it. If it fixes a cash flow issue, that's like an instant benefit. And as long as you retrade back into the market, you're kind of at an equilibrium anyway. The mistake is if you sell and then you don't get in the market for 10 years and then the market moves without you. That's what everyone kind of assumes what's happening. But that rarely happens. People generally get back in pretty quick. So this is a market. Fix your cash flows up. Interest rates are going up. If you're struggling to hold on to an asset, it's probably better to get a little bit ahead of the curve and then move quicker to get into something a little bit more, I guess, preferable in the next market. And because it's going to be a real divided market. I think certain areas are going to go backwards. This is not just a stagnating market. This is a market where markets will drop, and it already has this year. There's many markets in Sydney that have dropped over 10% since January. There's large numbers that have dropped over 7% too. So like it's dropping right now, especially in the higher price points. So it's something to be aware of, but there's other markets that are going up. So yeah.
So where do you see the opportunities emerging?
I think high yielding products that got the good fundamentals will be in vogue. Everyone's going to want them because they're easier to hold. There's less reliance on capital gains tax. There's less thoughts of, or less reliance on negative gearing rather. And there's also less reliance on capital gains tax because you're not just trying to sell out of that negative asset for the profit because you want to hold these things forever. So almost buy properties that you'd keep forever. That's my mindset. Because if you're thinking, all right, I've got to sell it because the cash flow is terrible on this thing, it's probably a shit investment.
Yeah.
Just buy the one that you're happy to hold until you're 80. And that's, there's hundreds of examples like, 4-bedroom homes in Caringbah. Like you'd probably keep that forever if the debt is right.
100%.
Because that's going to be worth a mozza in time. But then others, you need to fix the cash flow around it. So you might have, like, my ideal portfolio would be have a few great assets like that, and then you've got to offset them with equal or even more high yielding stuff, which could be anything from jewel keys to industrial properties to medical centers. Like you've got to balance it out. And overall, if the yield covers it, it will get better every year you hold because rents will grow and hopefully your debt won't grow with it. And if interest rates drop in the future as well, that's when you get a nice little bonus gift in terms of cash flow, and that'll happen eventually. But for now, it's going up.
But we're going to make sure that we don't necessarily bake that into the future projections. And I find it funny. It really rechanges the way that we perceive investing because, and I know this is kind of a divisive point with a lot of BAs because I know a lot of BAs think, hey, it's really important to factor this in. Others said, well, if you're factoring it in, you're going about investing wrong. And that's the exit strategy. And it's almost to your point, if you had a property where you had an exit strategy, that is perhaps not the right property to be buying now, because if you waited for it to grow for the sake of growth, that 20, 30% year on year sugar rush that we were talking about before, you didn't fundamentally want this asset. You actually didn't back it. If you were going to say, hey, I'm just going to sell this in 5 years to consolidate down, you never backed that asset to begin with because you saw it as a ball and chain. The fact that you had that exit strategy showed that it wasn't necessarily aligned with you and your comfort zone. Now you should be buying assets which you're comfortable having in your portfolio in 30 years.
Yeah, it's such a good point. And that's one of the things I didn't mention. There's another risk out there because you've got to remember how powerful the buyer's agent industry is now. We have the ability to oversaturate a market and double its growth just through artificial demand. And that's what's happening. There's a lot of people out there now going, all right, we're going to pump this market. You're going to get 50% growth in 2 or 3 years. Well, you do the math on that, by the way. Is it really that good? You're negative gearing it for a couple of years, and then you've got to pay your buyer's agent fee, stamp duty, capital gains tax, selling agent costs. Like after that's all washed out, you might be left with, 12% more or, whatever. You can do the math on it. But that is a strategy which is extremely dangerous, because if you don't get out in the right time, you're then stuck with 10 years of no growth. So hopefully you're very good mates with whoever's leading the charge on that market, because they'll tell you when they're going to stop buying, and that's when you get out. But if you're just waiting for the market, you'll miss it by 6 months.
Yeah, 100%.
And then you're not going to get all that growth. So I 100% agree with you, Liam. It's all about buying stuff you want to hold forever, because there's too many variables in the economy. No one's ever going to predict the market. And that's why I don't really get into it's going to grow, exact amounts. And anyone that says that, they're just talking out of their ass, because one interest rate changes that, one war and somewhere changes that. Now there's political pressure on residential property in Australia. That'll continue, by the way. So you can't predict things. So you just got to buy stuff for the fundamentals, hold for good. And if you sell, you're just selling to fix a problem and hopefully compensate it by creating an opportunity with whatever it is, better cash flow, better growth, better opportunity.
Yeah, and I couldn't agree more, especially on the political front. The argument that what happened in 1985, or when people like New Zealand, they ended up bringing back negative gearing. I don't think anyone should be factoring that in. Just because it's happened in the past and just because it's happened overseas, I certainly would not be building a portfolio on assumptions like that. No. Because what you're seeing at the moment now is, a lot of people online, there is that element of jealousy where it's like, well, if you've already got negatively geared property, you get to keep it. That's BS. People would prefer to take it from everyone rather than, hey, there's just a working class mum and dad that spent 3 or 4 years saving for a deposit for an investment property. Yep. And they've got one. They're not greedy. They're very good landlords. They look after people. They look after their tenants. And this is just a very minor thing that they get back. People would prefer to rip it from them as well. So everyone's dragged down. Yeah. I would not be building a portfolio based on any assumptions. I wouldn't even be basing it on the assumptions that interest rates would be coming down in the future. Fingers crossed they will. Yeah. But as you said, all it takes is a war overseas, and then it throws our market into a tailspin. Hey, Scott, to wrap us up, next 12 to 24 months, what should investors be focusing on?
Similar to what we're talking about. So yield will be a priority, and also rental growth. So what people are talking as a negative, like rents are going to go up for tenants, but the nature of all the changes is less supply, more tenants, more people not buying certain types of homes. So there's going to be an upward pressure on rents. That means your yield will get better. For both commercial and residential, you're going to see an increase in yields. Inflation's still high. They're going to go up. So your investment will get better. So you're going to have your day 1 yield and your year 10 yield. So focus on, is this going to grow at 5% per annum rental growth, or maybe you've got one that can double that, depending on how undersupplied that market is. Because people focus on the income growth more. So the capital growth, you can sell it and then sit on cash and then spend your cash down. But building your income up, it's hard to do, but if you do it, they're the most secure investors in the market.
Yeah, absolutely. Now, that is all we have time for today on Inside Residential Property. If you did like this, make sure you share the podcast with your friends or family to see how they can navigate and help them navigate the changes to the tax market, but also what investors are doing at the moment. And we'll be back at the same time in a month's time. But until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.